Good afternoon, ladies and gentlemen, and welcome to this very insightful session from HSBC Asset Management. My name is Rajat Handa. I represent HSBC Mutual Fund, and we have a wonderful panel of extremely experienced and intellectual people on the call to share their experiences and insights on some very latest and recent developments. Let me put it that way, developments as recent as a couple of hours today. This is one more step. This is one more endeavor from HSBC Mutual Fund to share information with our partners, with our clients on various aspects of capital markets. At times we do sessions on equity and equity related issues. At times we pick up the fixed income, which is again a very evolving and a very dynamic universe. And many a times we also talk about geopolitics, economics, issues which impact macro and micro factors in India. So today's session, if I can encapsulate and summarize, will be a mix of everything. We will try to focus on the monetary policy today because that is something which has been unveiled a couple of hours ago. And we would also want to talk about the practical impact of some of the statements being made by the RBI governor on how you and I can invest in the fixed income space. So, with that short background, let me introduce our panel for discussion today. So, first of all, we have our economist, Achala Jethmalani. Achala is an economist and investment specialist with the fixed income team. She's a senior vice president with HSBC Mutual Fund. She's into economic research covering India's economy and key global economies, focusing on the economic implications on investments. She provides inputs to the fixed income team at HSBC Asset Management India and has and also the global team with focus on India. She has approximately about 15 years of experience in the financial services space in India. Prior to joining HSBC Asset Management, Achla was the head economist at RBL Bank Private Limited. She holds a master's degree in economics from the Mumbai School of Economics, University of Mumbai. Welcome, Achla. We also have with
Hey.
us Asif Rizwi. Asif is Senior Vice President and Fund Manager with HSBC Mutual Fund. He has a total work experience in excess of 16 years. He manages a very important and critical funds in the fixed income basket. Just to name a few, he's part of the fund management of HSBC Short Duration Fund, the Corporate Bond Fund, Gilt Fund, the Medium to Long Duration Fund, and of course, the recently a 1 year old story, the HSBC Income Plus Arbitrage Fund of Fund. Asif is currently working as a portfolio manager in the fixed income investment team. He has pursued his BTech in chemical engineering from IIT Mumbai and the PGDM from IIM Calcutta. Asif, as I mentioned, has more than 16 years of experience in fixed income space, 8 years across organizations, distribution, trading, and debt capital markets of two private banks, and around 6 to 7 years with the investment team in the AMC businesses. Asif, prior to his post graduation, has also had some work ex. He has worked with the commodities sales team at a prominent global bank. Welcome, Asif, to you as well.
Good afternoon, everyone.
Yeah. So, with this brief introduction for our panelists, Achla and Asif, let me lay down the August proceedings and the agenda for today. So, what we will ask Achla to give her perspective on the third monetary policy this year. Every time we keep counting and we keep looking forward to insights from the very coveted and learned RBI panel. So we will request Achla to share her thoughts and opinions about what the policy holds for us as investors, as advisors. And once Achla has given her opinion on the MPC statements, we now then proceed to Asif, and we will probably probe him a little bit on the impact of the policy on certain funds which he manages in the fixed income space. Very interesting and very dynamic developments. I was going through the minutes of the MPC, the not the minutes, but the statements which were made, and a lot of questions and queries which come across. So, Achla, I now hand it over to you to give your views and a summary of the policy.
Sure. Hi, all. Thank you very much for taking the time out. Thanks, Rajat, for the introduction. As Rajat has highlighted, it has really been an interesting time, and we're still trying to gauge what the external situation will look like, but it's still in the backdrop. This is the monetary policy. As you can see, we've just tried to lay out what we think and make of the monetary policy today, and we're looking at it as a very cautious hold. It is just like the April policy. It has again showed its calm and composed demeanor at the policy, having to signal any kind of urgency, and also in fact averting any kind of debate whether interest rate defense and short-term interest rate higher will be opted for in order to counter the kind of FX pressures that not just India but a lot of other EM countries have also been facing, right? So in that backdrop, today's policy is really a very balanced and measured policy. We are looking at it as a cautious to vigilant. The reason is vigilant is of course there are a lot of external shocks and there is limited clarity as to how those will unfold. One, of course, is the West Asia conflict and consequently energy price shock that is still uh, continuing. Second, the only comfort is, of course, that oil prices have come down below 100, but still now again are closer to the $95 a barrel handle, right? That's one. Second is, of course, the weather risk. Clearly, the onset of monsoon has been impacted, that has been delayed. The risk of El Nino conditions developing as we head into uh, the month of June, further into month of June and July, that is clearly being watched out for. Last year, around this time, monsoon, when it had kick-started, we were already at a 25% positive zone. 2 days into the season, and whatever the latest number is actually showing about a 20% deficiency already, right? So onset of it is delayed, but still one awaits how that plays out through the season. So I think the governor in his statement and also the MPC panel has clearly laid out what are these risks that we are facing right now, and in that backdrop, I think it's both growth and inflation numbers also been changed, right? So if we recall it from its monetary policy report last time, it did lay out if energy prices were to average at $95 a barrel, then what would forecasts look like? And that number is in a way getting reflected in the 5.1% inflation print that it has put out. And in terms of growth, because of the extension of war since end February to now, there was some hope that there would be de-escalation, but since that has not come through, the supply shock actually eventually hitting economic activity is also now getting factored in. We did think that RBI would revise lower its growth forecast by 25 basis points, but it has marked it down to about 6.6%. It's a little lower than that. And in terms of inflation, the upside risks were like, yes, it could be possibly looking at around 5% handle, with it obviously touching its tolerance levels by, say, December of this year. Right. Of course, whether this gets magnified and intensified further is something that only some of these two exogenous shocks would determine eventually. One comforting factor from the policy, of course, for us was the core CPI number. When you look at the overall revisions, core CPI is revised high only by about 30 basis points, right, to 4.7%. And the governor did reiterate that if you exclude precious metals, that number is even lower. So that's one aspect that would also be important to watch out for apart from the headline number. In terms of other takeaways, of course, one is the MPC and one is the RBI. They clearly had two distinct roles to play at this policy. The MPC did uh, balance its act by giving out these projections and taking a very unanimous vote on a neutral stance and holding off on any kind of policy rate adjustments. But when you look at the RBI, it has really taken care of the macroprudential aspect of it when it has really laid out what kind of steps it would take in order to mobilize deposits or probably create an environment which is conducive to bring in more dollar flows. Now, if you look at the next slide, we've actually tried to lay out what are the steps that it has taken. In over here, obviously, when you look at it, it has clearly delinked rates from rates and FX, unlike, as I mentioned, countries which have used interest rates as a defense to curb currency pressures. India has actually chosen an alternate route far more targeted approach, something that will probably fructify in better outcomes, hopefully, is of course through one reform measures. One, obviously, is the government ordinance that it has decided to exempt tax on investments in the debt space. It's one. And on the RBI's side, it has actually taken some of these measures, especially FPI investment through GSEC across far specified securities. Then there are other measures such as obviously external commercial borrowings is one, wherein they have actually kept the window open till 30th September, so that there is effort and endeavor to bring in those inflows in the next quarter or so, rather than making it more prolonged or long dated in nature. Similar was the case with the garnering or mobilizing NRI deposits and FCNRB deposits. Again, the window is kept till end of September. Over here as well, it is something similar, but not exactly some 2013 like playbook. But obviously, what it has helped to do is ensure that there are some dollar flows coming through these measures rather than taking very short-term steps, right? Lastly, on export proceeds, I think that was one step that they had taken when when tariff talks and tariff pressures were going on, when they had extended the window. So what they have done is restored the window so that whatever dollar realization happens from exports comes through sooner than later. So I think in a way, those are very positive steps. Any kind this crisis, in a way, one can say was not missed. It has been used opportunistically in order to bring about some of these measures. Also, when you look at the announcements, they do not indicate any kind of sense of urgency from the RBI. It even in its comments, governor did allude to the fact that it is something that when it comes to external sector, the buffers are in place. It is that buffering the buffers is what these policy steps would help to do. It in our outlook, what we are saying is, in the next slide, we've tried to lay out one external sector category. When you look at it, the external environment did influence the policy reaction function, but of course it was outside of the MPC's purview, right? A lot of these macroprudential measures have been taken by the RBI, which eventually should help ensure that inflation targeting stays in place as it arrests pressures on the currency going forward. The positive aspect of this is that it did not influence your policy rate trajectories, which means that your growth sacrifice ratio is going to be far lower from the monetary policy standpoint. That's one. So in terms of our projections and our estimates for both growth and inflation, I think it's broadly tracking what the RBI MPC has laid out. On growth, we are more on the 6.5% handle. Downside risks could emerge if, of course, you start to see worse weather-like condition, as it could possibly impact your agri and overall rural sentiment goes down. And second is, of course, if there is premature tightening, then your growth could look weaker. But as of now, we would like to maintain our view that 6.5% on FY27 growth is what is more likely. Today, later on, we last year's GDP numbers and last quarter GDP numbers as well. So that's something that will be interesting to watch out for. Of course, there will be a drop from 7.8% to 7.2% kind of a figure, but still it is fourth quarter would be a far better number. The idea would be to watch out for what happens in July to September quarter, because the impact of war would start getting reflected 3 to 6 months in here on. On inflation, we are at 5.1 to 5.2%, considering all the major upside risks. One, of course, is crude. Obviously, so far the average crude has been about $102 a barrel. For us to see any kind of meaningful drop for the rest of the year would mean that oil goes back to 70. Now, that likelihood seems a little less possible, right? So considering upside risk to food inflation, we are working with a 5.1 to 5.2% kind of figure, with almost tilted to the upside, because we really don't know how perishable prices would react. So that could add another 20 to 30 basis points to your headline inflation print. So that's where we stand on inflation. Of course, by the time you reach December, you will see an inflation print of about 6%, but I think that is broadly getting captured in RBI's MPC forecast as well. So it's not that it suddenly you or the markets would be caught off guard, and that would warrant a sudden caution that hey, inflation is way too higher, and we are going to adjustments being sharper or more aggressive. Because what we're saying is that it is already getting baked into RBI MPC's outlook and forecasts. And Lastly, I think these exogenous shocks are something to watch out for. How they play out, we will know in the month of in the next 3 to 6 months, and therefore we remain a little more nimble-footed in our approach, and we would continue to assess how some of these risks play out. And therefore, in that backdrop of heightened uncertainty, where there's limited clarity on what is the intensity of both growth impact as well as inflation impact, we are taking a view that a policy rate reversal is obviously has come through because of these exogenous shocks. Now, the timing of that first rate hike is slightly tricky. Markets, some pockets in markets are saying an August rate hike, but when we are looking at our assessment, we're still saying that the first rate hike could be possibly placed in the second half of this fiscal year, and that's but because by then we will have little more clarity overall. Monsoon pan out, inflation trajectory, any kind of de-escalation in West Asia, the ceasefire has been quite fragile and by its nature. So how that all shapes up and culminates into price pressures is something that we'll be watching out for. And lastly, in terms of liquidity, there was something that is still an interesting space. There has been de facto tightening, like Saugata Bhattacharya mentioned at this last policy. We've seen rates move up, but that has been a result of how yields and rates have moved globally. A lot of DM central banks have tightened in the last 2 to 3 months. Australia being the topmost, who has hiked rates thrice so far. So a lot of DM countries are seeing rate hike trajectory. What would be important for us to watch out for is how the US Fed moves. The first policy under the new Fed governor, Kevin Walsh, is something that is being closely watched out for. One of the reasons is because at his nomination ceremony, he did indicate that he intends to have a regime change. There would be a lot of overall at the Fed underway. So is it that there'll be no more forward guidance? How will the communication pan out? Will assessment start looking different? So a lot of these factors would also be an influencing measure when it comes to how India starts to look at its policy trajectory. But until then, given how India's inflation is looking like, there is still elbow room for RBI and PC to stay on pause and assess how some of these situations and things pan out, right? The RBI governor did mention that they remain data dependent and will take a meeting by meeting approach. I think that is one of the good ways to provide some kind of guidance instead of having no guidance at all or having a point on target kind of guidance. So in terms of liquidity, the RBI governor did mention that they intend to keep it adequate. And now where that adequate lies is something that we think it will be in the 0.6 to 1% kind of NDTL range. Since the war kicked off, although April month was a month where we saw sufficient surplus, it was only the month of May where we started seeing some bit of liquidity tightening come through on account of FX intervention, possibly, then CIC leakage. Credit offtake also started to pick up, but some of these items would start reversing, and also the RBI has been ensuring there's durable liquidity to FX swap, for example, through VRR options and auctions. So what is happening is at least their endeavors is to ensure that liquidity remains well in positive territory. Now, it may not be as high as 1.5% that we saw in April, but at least it's not going down below, say, 0.5% on a sustained basis. So that's the take on liquidity as well. So that gives us enough logical reasoning to assess that at least the RBI and MPC are not looking at immediate or premature kind of rate reversal, so to speak, right? So I think that's broadly our sense on some of these major key factors. Now, in terms of external measures that it has actually taken, it's a little difficult to say how much dollar inflows will come through because of that. Some bankers who have been speaking, even they have limited clarity how much it would really end up mobilizing. But the point is that if last time in 2013, if the window was provided, and if total incremental mobilization was about 30 to 35 billion, so it is still possible that we may see a decent number over there in terms of dollar mobilization. How much of that success happens remains to be seen, because last time rates were far different. In India, rates were different. Globally, rate scenario was different. So that's something that needs to be watched out for. But obviously, overall, directionally speaking, measure-wise speaking, it's a definite positive. Lastly, I think some of these measures, given that India is looking at a BOP deficit of about 50 to 70 billion for FY27, uh, these kind of dollar flows would obviously help narrow that balance of payment deficit gap. So I think from that standpoint also, it looks more positive than having no FX measure at all. So that's our take on the policy overall. I think it has been broadly in line with what our expectations were, with some positive surprises here and there. So I think that's on my macro
Yeah.
take. Asif can probably
Yeah.
take over and touch upon on some more details on the measures and uh, portfolio.
Thank
Thanks.
you. Thank you so much, Achla. I think the limited time that you had to analyze those statements and all, I think it's a fabulous summarization that you've given us, along with the forward-looking view. Ladies and gentlemen on the call, I don't see any questions in the Q&A box. My request is please put in your questions. We will have Achla at the end of this session to address your questions. And now I would just request Asif to share his thoughts on how the HSBC fixed income funds are positioned, and specifically on certain segments of the fixed income market which may get impacted because of the policy statements. Over to you, Asif.
Um, yeah, thanks, Rajat. I think before I start speaking more about what segments look good and where we are positioning broadly, I think the more important thing is to just try and understand, just take a step back and try and understand before the MPC policy, what was RBI's biggest concern? What were they trying to solve with this in this policy? I think it was twofold. One was currency weakness, the other was capital flows. One might argue why they did not do a preemptive hike. Some section of the market was expecting a hike. But if you look at, their estimates, which they've come out with both on the growth and inflation, so it's only when we believe that, when inflation starts going closer to 6%, which is where, RBI will kind of be a little bit more cautious, and that's where probably the first action might happen. Given the next 2 quarters, they are seeing, inflation prints around closer to about 5% or lower than that. I think that is where they have kind of seen through this period. The other thing is, again, if you look at, rate hikes, this entire event that has happened, and, the risk of inflation that has come up, that is more a supply side driven inflation. This is not a demand side driven inflation, which, rate hike will kind of resolve right away. So I think it was a very good step in that sense, that they really calmed nerves by not doing a preemptive hike. Or changing the stance for that matter, both in line with our expectations. But what was more critical was, and what markets were really looking at was, what are the other measures that they come up with? And that is where probably I believe RBI is not disappointed. They've come out with a slew of measures, both RBI and government earlier in the day, uh, predominantly, kind of addressing these issues. On the currency and as well as on the capital flows. So I think Achal has kind of already covered what were the measures that have come out. I'll just try and, see what is the possible impact of those measures. I think the biggest impact is this acts as a sweetener for FPIs. I think FPIs have, kind of there's been a fair bit of outflow that has happened. Again, more on the equity side, but still, in terms of a debt incremental flows coming in, I think there was a fair bit of caution there, because US rates are also fairly high in that sense. The differential is low, but this kind of addresses that because it acts as a sweetener, both on the withholding tax removal and on the capital gain tax. That is something which the FPIs have been asking for, and that really kind of is a huge positive in our view. The other is this kind of arrests the rupee depreciation. So we've seen a fair bit of rupee depreciation over the last 1 year or so. This kind of addresses that. If we are able to bring in garner some capital flows through this, and Achala kind of alluded to that, and there'll be a lot more discussions around that going forward. I think that will arrest rupee depreciation, which is the first problem that they were trying to solve. The other thing which is kind of a side effect of what happened today is more because if, let's say, FPIs start coming in into the government bond market, Indian government bond market, that also becomes a positive from a GSEC demand supply situation. So that kind of adds a little bit of we are struggling with the GSEC demand supply. We've seen a fair bit of GSEC plus SDL if we combined last year, even with 125 basis points of rate cut and with so much of large OMOs, rates actually moved up. So this will kind of add, fill in the jigsaw puzzles, one of the puzzle, pieces of the jigsaw puzzle in terms of from a GSEC demand supply perspective. The other thing is if banks are actually able to, garner deposit, and that probably will, and now that RBI has come out and government has come out with these kind of measures, I think the push will be to make it successful. So if this indeed works, banks, the pressure on bank deposits will also reduce, which in turn, from our market perspective, will also help, kind of reduce the CD borrowing probably, and that reduction in CD borrowing will also kind of transmit into a corporate bonds. So we'll see the impact there over corporate bonds. So that is something which we'll be looking out for. Uh, now that we've discussed what are the positive, I think it's also important to see what the risks are and something which RBI would have had in mind. So the risks are twofold. Like the biggest risk is, the war is still continuing. You don't have a complete resolution to that. This can linger on for a couple of months more, and which is where the impact on inflation, on currency, and everything will continue. The other risk is again a byproduct of this. If it picks up faster than estimated, and have the El Nino impact, we start seeing a closer to 6% print even before the Q3, which RBI is estimating. That is probably where they'll have to kind of react probably much quicker in terms of the other side of the uh, rate cycle. So now just to address in terms of what the market movements are, and I'll just come back to the slide which we have in front of us. So in terms of market movement, we've seen a fairly sharp reaction. Okay, so in terms of if you look at just 10-year GSEC, so that has moved by 5 basis points. But if you look at the 5-year GSEC, that has moved down by almost 15 basis points today. If you look at the CD segment, that has moved on by about 20 basis points. 2 to 3 year corporate bonds, in fact, at one point of time were lower by about 25 basis points, but as we speak, we are about 15 to 20 basis points lower on a day-on-day basis. So a fairly sharp reaction in terms of market has taken this positively across GSEC and corporate bonds, and I believe that is something which is very positive in that sense. Now, just to come back to where the risks lie, and this slide we kind of use in terms of more from a top-down analysis and just try and figure out where we want to position our duration. So if you look at the positive sides, which are the green blocks, RBI liquidity measures, RBI has been fairly supportive of liquidity. So that stands on the positive side. Domestic growth slowdown is something which we need to look out for. Obviously, RBI's estimate as of now talks about a 6.6% for only a 30 basis points lower number for the full year growth. But if that really falls, and that falls sharply, that is something which RBI will keep in mind. So that kind of stacks in the positive side. The third one is something which has got added today. That's the FPI tax exemption that has come out, and this can probably act as a precursor to a Bloomberg global accreditation. So that is something which did not fructify in January when we were looking at, and in mid June, in mid 2026, that is up for review again. So that is something which can act as a fairly positive, and it kind of helps us in terms of getting that addition. And if that comes in, that again becomes a positive both from a capital flow side and from a GSEC demand supply positioning. Um, Again, on the factors which are still remaining negative is again you see have a fair bit of GSEC SDL demand supply imbalance which is there. Probably FPI coming in, RBI coming in later in the year with OMO purchases will kind of address that. But as of now, we're still looking at a heavy GSEC plus SDL supply for the full year. Geopolitical tensions continue, and that is something which is I think the entire world is watching, and that has impacted us a fair bit. So the earlier that resolves, the better it is for us. So still negative because the risks still remain. Balance of payment and current account deficit, this is something which they've tried to address today. So if this really works out, we are probably looking at this factor going towards the more of a neutral kind of a segment. Actually, can you look at the next slide? Yeah, so this is what I was talking about in terms of market reaction. So I just want to take a step back, see how much rates moved in from the December to March 26 period. We had a fair bit of yields move up. You see 2 3 year GSEC all moving up by 60 70 basis points. 10-year GSEC was up by about 40 basis points, and a lot of that reaction happened in March. In after end February the war broke out. That's where we've seen that kind of reaction. Corporate bonds saw a fair bit of sell off. 2 to 3 year corporate bonds were almost 70 basis points higher. What has happened since then is because of the continuation of the war since March 26, we have seen corporate bond spread widening further. If you look at just the absolute levels on 2 to 5 year, 2 to 10 year corporate bonds, the curve is completely flat. So this is as of yesterday. So this is a representative PSU issue that we are looking at. So the curve are completely flat. Today we've seen a little bit of reaction, specifically on the 2 to 3 year, 5 year segment. And that is something. So if you look at where you're positioned, uh, the entire curve is flat. If let's say you have to take a bet at this point of time, this is something which we have, kind of uh, run through our across our funds at a flat yield curve. If you're talking about, so there are two ways that yields can move from here, and we are talking about a rate hike at some point of time during the year. So either so what happened today, that you didn't have a rate hike, the stance did not get changed, which means the shorter end of the curve has really benefited. So that is one. The other, if is let's say we move into a rate hiking cycle somewhere down the line, we are talking about a parallel shift of yields. Your curve is already flat. You're talking about a parallel shift of yields. Even then, you're better positioned in the 2 to 3 year corporate bonds, which is where we've kind of positioned our funds. So if you look at our, our core bond funds, and I'll come to, the recommendations, we have kind of positioned more on the 2 to 3 years space. We have taken a little bit of hit because yields moved up very sharply, but we still believe that there is more value over there than, other segments of the market. Uh, so in terms of where we believe, so in overall duration positioning, if I can come back to, so we post today, I think there's a little bit of positive sentiment which has come in, and I think a duration positioning which was probably neutral earlier, we'd rather say it's neutral to marginally overweight. We would want to be in this kind of an environment. The segments that we like is the 1 year CD segment is one, still 225 basis points over, overnight rates. I think there's a fair bit of carry which is there to be captured. And if, indeed the pressure on deposits reduce, that is one segment that can really, do well. And the following one is the, 2 to 3 year corporate bonds, which is again 100 and 125 basis points spread over the corresponding GSEC. We've seen a fair bit of sharp sell-off there. But at absolute levels of, close to 7.5, 775, these still look fairly good in that sense. So if I have to look at funds that make sense, I think the entire money market category, that is the ultra short money market, low duration fund, which has allocations to 1 year CDs trading around 7.5 as of now, that segment looks fairly good. And in terms of the core bond funds that we have, short duration fund, banking PSU, and corporate bond fund, which are predominantly positioned in the 2 to 3 year corporate bond space, I think that still has a fair bit of value. So those two categories, in this kind of environment, we don't really want to go on the longer duration side. So, we might take tactical calls because if, Bloomberg Global Act does come in, there could be a case for a tactical call in GSEC. But we would still, don't want to go overweight on the GSEC segment. I think the overweight positioning will continue to remain on the, 1 year CDs and 2 to 3 year corporate bonds. So that's it from my side.
Hey, thank you so much, Asif. I think you did justice to the time we had and explained in a very crisp manner, in a very precise manner, the impact which certain segments of the market would have. And I'm getting some questions on some of the stuff shared by you as well as Achla from our audience. So let me straight away jump into those questions. The first question, and some of the questions are initially on the policy and the statements. So we'll probably have Achla answer them, and Asif, I'll come back to you on some of the segment and the fund related questions. So Achla, the first question which we've got is on the the overall stance of the policy. So I know it's like a summary question, but the question is that the repo rate has been unchanged, and the neutral stance also remains and has been retained. But is it truly a neutral policy, or is it effectively what we are now seeing in the media as a hawkish pause?
I think that is something that's open to everyone's interpretation, but I think we are still reading it as a very cautious or vigilant kind of a hold. There was hawkish leaning. If you look at CPI forecasts, then that could be one way to read it. But when you compare it with April policy, when it laid out the scenarios, if Brent were to average out at a higher level of say $95 a barrel for the year, then you would see an inflation print of 5.1%.
Yeah.
So those numbers are still in line with what it had mentioned and stated in the April policy. Of course, the wording that there are upside risks to inflation suggests that there is more to inflation risk. So when I did a quick search, for example, the word inflation made its entry nearly 22 times, right? But if you look at the repetition of those words in its outlook, that was nearly about 10 to 12 times, right? So clearly, and when you compare it with growth, the mention of growth in outlook and its reference to growth was only about 2 or 4 times. So clearly, the policy leaning and focus is on inflation rather than growth. So I would therefore say that it is a cautious to vigilant hold. Its stance on liquidity, approach to liquidity does indicate that it is not still on the hawkish leaning per se. If we start seeing some retractment in those measures, we would have called it out as a hawkish hold. So that's how I'm interpreting it.
Makes sense, and you have been alluding to the semantics in the speech, and that also makes it very, very interesting. The 22 times the word came
We're
in,
living in the
that's
world of
interesting.
LLMs, right?
Absolutely, absolutely. All these things help, to analyze what the lines say and also what you can read between the lines. So thank you so much, Achla. There's one more question on the growth outlook since you've answered on inflation. So RBI is very clearly, as you mentioned, very clearly in your state in your speech that the growth forecast has come down from 6.9 to 6.6%, and this is the FY27 forecast. What do you think are the biggest risks behind this or after this downgrade? Also, people want to ask you and I want to understand, is this slowdown cyclical or indicative of a deeper structural challenge?
That answer requires a separate webinar, Rajat. I would like to say that. So, see, we don't have the nuances of the headline number. We just know that growth has been marked down by 30 basis points, and clearly it comes in the wake of the supply shock. When you look at commentary, when you look at some of the lead indicators, I would concur with the view laid out in the policy as well that economy is still showing signs of resilience rather than cracks. I think what we have to really watch out for how the war and weather shocks eventually start to play out. So sector-specific impact will be known only eventually. But clearly, if inflation is high, your disposable income takes a hit right away, right? So there is no taking away of that. So I think we'll have to see what sector-specific impacts it will eventually have. And as I said, we have growth numbers coming out today for the last quarter and also for FY26. So probably we'll have a little more clarity because only last quarter were new base data released, right? So I think let's wait some more to assess what is it that is going to impact. And clearly, from speaking strictly from RBI monetary policy statement wise, we just have the headline number. They've not really given how much will be consumption, how much will be government investment, how much will be private investment. So those numbers are not something that RBI lays out. It just gives the headline number.
Yeah, so we'll have to wait for the devil in the detail to come out. And as you said, there is much more data awaited.
Absolutely.
So we'll wait for that, Achla. Thank you for that. Just moving the needle to inflation, because obviously, this was the writing on the wall. Everybody has been talking about imported inflation. So a couple of questions on inflation, Achla. You may want to answer them in whatever order you feel appropriate. One is inflation forecast at 5.1. Is this becoming a more persistent problem than what we all previously anticipated? And a related question on inflation is how significant do you feel are the second round inflation effects in the environment? And obviously, our vulnerability as a country to imported inflation because of energy and commodity prices.
Yes, I think what this energy shock has clearly brought out our vulnerabilities, and we all know it, where it has hit us the hardest. So I think no point speaking of that. And second order effect from such a key input, which is energy prices, whether you look at oil, you look at gas, and the derivatives of it, is something that you cannot really run away from. So clearly, it is what has fed into inflation forecasts and inflation for India, and also probably led to where we are in terms of our macroeconomic factors, which is both growth and inflation at this point in time. In terms of whether this is more generalized and second order effects, as I said, it really depends on pass through. A bit of second order effect is something that you cannot really deny because government has started to pass through some of these higher costs onto the consumers. So clearly, once it starts seeping into logistics, transportation, freight costs are going up globally. So it will eventually start feeding into your inflation. What is the intensity of it? As I mentioned at the start of it, really depends on the duration of the impact, especially the conflict. And second is eventual monsoon turnout, right? If that also turns into a supply shock from the agriculture sector, then you could see inflation readings inching higher. Uh, Coming to inflation becoming more persistent, I would sort of disagree with that because clearly, basis data, when you see a higher inflation print of about 6.7% was post the Russia-Ukraine conflict, right? That was around FY23. Post that, we've seen inflation actually come down. Core inflation is also one of the metrics that one can look at, which is just hovering about 2% if you exclude precious metals and so on and so forth. So inflationary pressures for the economy for India have not been so generalized or so entrenched in the system. So that's one. And I think that is what has really given inflation print at 3.5% is something that has really given the elbow room for India to react in its policy the way it has reacted today, right? Otherwise, we would have been in different camp altogether and not so calm and composed as compared to some of the other EM peers. So how entrenched does inflation get would really depend on the two W's war and our weather. But for now, obviously, 5 to 5.5%, testing the upper bound is something that is really getting worked and baked into the numbers.
Fair point, fair point. And actually, as you said, I don't remember the last time we had a webinar where questions came around inflation. I mean, it was a very benign issue for many, many quarters in the last couple of years, right? So no one was complaining then. But thanks, Achla, for this. There's another question now moving on to geopolitical, because you've covered, I think, questions around growth. You've covered questions around the intent of the policy. You just answered something about inflation, and is this a persistent threat, which you say no. Then let's move on to global, and after that, I'll very pointed questions to Asif on what investors should do right now. So, Achla, from a geopolitical perspective, there are a couple of questions which I've got. There's a very interesting question which has come from Nidhi Shah. And Nidhi is asking, in case there is a resolution of the Middle East conflict before the August policy, will it make any material difference? I personally have my answer to that, but I'm not the economist. You are the economist, so you can answer that. But before you answer this, two related questions on geopolitical crisis. One is, if you can just give a helicopter view on and a limited view on the influence of this conflict, overall influence of the conflict on India's growth and inflation trajectory over the next year. Yeah, not the current year is over. And how serious is the current volatility as a threat to India's inflation outlook?
Yeah, okay. Great question, Nidhi. Yes, you're right. I think it whether it changes things materially or not would depend on the other W, which is how the weather shock starts to play out, because India is now also looking at a higher food inflation trajectory, something that we are saying that will be around 3.5 to 5%. It has now moved to 4%. So that aspect, which is a heavyweight in CPI still at about 37%, both food and beverages. So it at least would add comfort from the energy shock angle, wherein the government may not be compelled and forced to keep passing on the higher costs to consumers. And second channel of that would, of course, be input costs, right? If you start seeing lower producer price indices also moving lower, and for last WPI print, we are due for a new base. The last WPI print touched about 8%. Now, what that does is that it eventually starts feeding into your consumer prices with a lag. Sometimes that lag is 3 months, 6 months, 9 months, right? Given that India's demand has been on the weaker footing, then I think producers are a little hesitant to pass on the costs entirely. So while if there's a de-escalation before the next policy, which is August 5th, that would be a positive, because suddenly you'll see a reversal in commodity prices, maybe not a full reversal to what the pre-war situation was like, but at least you'll start seeing prices coming down. And second order of that, of course, would be the currency. Sentiment-wise, the currency would start looking better. So your imported inflation automatically would start easing down, right? So we are definitely staring at higher price levels compared to last year. Now, the magnitude of that price level markup would be contingent on some of these factors, but a de-escalation would definitely help. It would just give that elbow room for the monetary policy to assess and then react, and not just prematurely respond in uh, being worried that suddenly inflation would start going out of hand and stay above 6% for over 3 quarters. So I think at least that will start giving some respite. So I think de-escalation will be positive.
Sure, sure. That's good. And I think with this question that Nidhi had raised, you also answered the other sub questions which were asked by some of the other people. Thank you, Achla. Achla, if there are any more questions, I will come back to you. I'm just reading the Q&A panel
Sure.
right now.
Thank you.
Yeah, so you can please stay on the call. Let's move to Asif. Asif, you are the fund manager. We heard the economist, and you are the person who's actually the having the fiduciary responsibility of money. So there are very pointed questions. But before we come to those pointed questions, Asif, let me quote one of our participants, Hari Ramachandran. Hari Ramachandran is asking a question, and he wants to give you the crystal ball right now and saying, Asif, I mean, obviously, we're all very optimistic with the announcement which came that, FPI is now need not pay taxes on the interest on gilts. So, what is the likely quantum expected from these FIIs or FPIs post today's announcement? And also, will this actually materially and significantly help the rupee depreciation from stalling?
Yeah, so that's an interesting question. I think the entire market is trying to get a
Yeah,
grasp on that number.
right.
So there are two, three things which you need to look at. So one is in terms of obviously these are sweeteners from an FPA perspective,
Mm,
both the taxation, the FCA and RB, and in the entire set of measures that were announced. What we need to understand is also because, so if you look at the FCNRB, which happened in 2013, so at that point of time, your US rates were fairly low. So the differential between the US rate and an India rate was fairly significant. So for that point of time, we looked at a number which was about 25 to 30 billion, and that is something which has come out just from the FCNRB.
sure.
Now coming over here, so there are two, three aspects to look at it. One is the FCNRB piece. That again, we'll have to look how much money does come in because the differential is low. But still, in terms of, if you're removing the withholding tax and you're removing the capital gain tax. So just on the interest income, let's say you have a 7% bond, you're talking about, 20%, uh,
Yeah,
which goes out of that. So a 7% effectively is a 5.6, which is not in this case. So if that happens, you're talking about the differential being still fairly decent. You also have to account for the fact that, there's a FPI, from a currency perspective, you're looking at, INR depreciation, a natural depreciation over a period of time. So you have to
3%.
account for that also. So that is one part of it. The other part of it is which, if indeed India gets added to the Bloomberg Global Ag, our estimate is this could bring in about 25 billion in terms of flows.
Okay.
So again, let's go back to what was the problem that we were trying to solve.
Hmm.
If you look at, and Achla would have a better hand on this, but just in terms of, balance of payment, what was the number that we're looking at? Anywhere between 50 to 75 billion is the number which is the deficit. So these two aspects, if you combine that, actually, it depends how much of a success it becomes. But
Hmm.
if these two indeed works out, you're talking about a 45-50 billion number coming in. So that 45-50 billion reduces your balance of payment problem to a fairly, decent extent. How much number actually comes out is obviously anybody's guess, but these two factors are something, and both of these combined, you could look at a number of around 45-50 billion. But it depends how these pan out. But our understanding is given that government and RBI have, come and announced this together on the same day, there is a Bloomberg Global Ag, which is due for discussion again in mid of 2026. I think this is timed very well in that sense that it gives me a feeling that probably this is heading towards a positive note.
Yeah.
If indeed that comes about, we'll be in a much better situation. But having said that, you're probably looking at a combined number of 40-50 billion, but we'll have to see in terms of how this pans out.
Yeah, sure. So we did manage to hear that number, which is very elusive at times at 25. I'll stick on to that. But interesting, Asif, and I'm sure it can be much more. As you said, some of the variables can play out. Moving on to the next question, which a lot of investors are calling. So I'll not call this stagflation, especially when my economist is on the call. But there are indications that you're seeing a higher inflation and you're seeing growth forecasts falling, and this kind of looks like it will continue for a few more policies or a few more quarters. Again, coming back to Nidhi's question, that what if everything resolves, then this dilemma can be resolved. But in case status quo prevails, and you have higher inflation and you have lower growth forecasts, Asif, how should fixed income investors position their portfolios?
So again, just to again take a step back in terms of what the RBI said. If you look at the
Hmm.
estimates, they have increased inflation estimates by 50 basis points. They've reduced
Yeah.
growth by only 30, which is where they believe growth is probably on a slightly more stronger footing in that sense, compared to, let's say, inflation, which is, kind of looking at multiple risks that can, kind of add to inflation. You're talking about the war itself, El Nino impact. You already have a negative base in terms of, food inflation of last year. So there are more factors which are coming in from which kind of push inflation higher. But in terms from a growth perspective, you look at, you see till now also, even from an IIP perspective, the numbers that have come out, IIP, whether it's IIP, whether it's, your PMI numbers, they are still fairly resilient in that sense. And why is because there's been a fair bit of, upfronting of manufacturing activity that has gone into. So when, in March period, you saw, there was a little bit of scarcity for raw materials. People have gone and overproduced. So this impact and, growth numbers don't really show the next day. It takes a fair bit of time for growth numbers to show. So your falling in growth will probably is, there is some time away. So in this kind of environment, it's not that you're inflation is going to go and growth is going to fall really substantially. It's going to happen over a period of time. Obviously, there are multiple risks to both of that. Having said that, in this kind of environment, if you look at a medium term view in terms of where rates are headed, inflation is something which it's real. It's going to happen over a period of time. When we reach that 5.5, 6% number is, we've discussed that.
Yeah.
But having said that, and I just go back to what I discussed earlier, I think it's better to stay in, lower duration, fairly decent accrual kind of products. We've seen a fair bit of sell-off. Both on the 1 year CD segment, on the 2 to 3 year corporate bond segments. And this I'm talking about just, just AAA segment. So just PSU bonds have seen a fair bit of sell-off, almost 100 basis points over the last 6 months or so. So in this kind of environment, your entry points are fairly good.
Okay.
Even let's say you're talking about any of these funds, let's say a money market fund or a short duration or a corporate bond fund, all these funds are anywhere in, almost 200 to 250 basis points over your overnight rates, which is a fairly decent accrual that you're getting on a
Hmm.
safe kind of a portfolio. And
Yeah.
entry points are good. So had we been, let's say, 100 basis points lower, probably these entry points would not have been that,
Hmm.
favorable in that sense. But now that we've seen a fair bit of sell-off and, uh, and the good thing is RBI has kind of calmed nerves by not doing any preemptive step today. So which we believe that lower duration products, 1 year, 2 year segment, your money market fund, ultra short duration category, short duration corporate bond, banking PSU, these are the segment where, depending on how much of an investor horizon and risk appetite the investor has, if people are looking at a shorter duration, obviously ultra short and money market, people who have the appetite to go into the 2, 3 year segment, play this
Yes.
corporate bond story. That plus, if let's say you have the Bloomberg Global Act coming in, or there's a fair bit of positive note which comes around on this FPA bit, I think that is something you can play out through the 2 to 3 year corporate bonds. I am still not. In this kind of environment where rates are eventually heading higher, I would not want to go and take a medium term call on, let's say, a high duration product. So
Hmm.
the idea is you can look at duration more from a tactical perspective, uh, but if you look at a medium term, rates are probably inching, higher, which is where you have to look at pockets where there is value. And we believe as of now, these two segments provide that kind of opportunities.
No, absolutely. And I think bullseye, because you actually mentioned very clearly where our preferences are, what views we want to give. Obviously, investors are free to choose and decide if they want to take a tactical call, if they have a view on longer duration bonds and GSECs, who are we to tell them? But obviously, when the people want to know, what does ASIF and what does HSBC Asset Management think about the near term future. So the near future is typically, Asif, staying a little bit on the shorter side of the curve, the shorter end of the curve. Up to 1 year, if people have a time horizon, then like you mentioned, you have the money market, you have the overnight, you have the liquid, you have the ultra short. And obviously, when you talk about taking a slightly longer view, if people have funds for maybe 2 years or so, then you mentioned the other funds. And all these funds, Asif, if I'm not wrong, carry a modified duration of anywhere between 1 to 3 years, right? It's that range that you're talking about. Am I right, Asif?
Yeah, so in terms of a SEBI requirement, it's just short
Yeah,
duration which has to maintain a
yeah,
we call it duration between 1 to 3 years. But as
yeah.
of now, all these three funds are broadly positioned into a modified duration of two
That's
and a
right.
half.
That's right.
So so
That's right.
that's where we are positioned as of now.
Yeah, yeah. And that ties in with also the graph that you showed, and you showed us a sweet spot where you can actually take the maximum benefits of the spreads, which is this segment. Okay. Thank you so much, Asif. I think this is very interesting, very insightful. Unfortunately, we're running out of time. I know there are a couple of other questions which are coming in, so I'll request you to keep listening in, keep tuning in. We have these sessions once every month. We also kind of tie this up with events which happen like the policy or the budget or anything which is of critical importance to you or your investors. Asif and Achla, many thanks for sharing your views on the policy, on the funds, on certain segments of the market. Investors and our partners who joined on the call, I hope you found this useful. My request is please keep logging in to the HSBC Asset Management webinars, which happen on a minimum frequency of once every month. Do also give us your feedback if you want us to cover something which you desire or which we have missed out in the past couple of months. We'll be very happy to incorporate your feedback also. With that, I will want to say goodbye and I wish you all a very happy weekend. Bye bye.
Thank you very much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.